you. Okay, very good afternoon. I always get nightmare after I listen to Patrick. I'm not sure to give my wife or my children or anyone else to give. But I always find it's very worthwhile to come for ST Property events. Right? I mean, you get goodie bags, you get the lunch, you get a lot of investment opportunities. And I heard the rebates is really taken up. Yeah, just now I heard from the organizer. I thought, hey, I still want to take advantage of this rebate. Initially, I thought rebate, you know the 8,000 that they give one? I thought it's given by developers, so it's like you pricing, right? But actually it's given by ST Property. So you should really try to take advantage of it. And then they are also so considerate, they give you pillow. So in case, because I'm not Patrick, if you dare to sleep during his session, you'll probably get nightmare. In case you cannot take it, then you can just take out the pillow and just make yourself comfortable. But try not to disturb your neighbor too much. Because this topic, to rise or not to rise, since 2011, I've been saying interest rate will sure go up. The only thing is I don't know when. So I mean, isn't that obvious? Very common sense, right? So for those of you who are here, you're also thinking, hey, how will the interest rate impact my investment? So before I get into it, like Patrick, we are regulated by MAS, so this is our disclaimer, but mine seems to be longer than his. Please take note that all your investment decisions, please make sure you check with the necessary consultants, professional first, yeah? Now, first of all, we need to understand how is Singapore interest rate formed. I mean, we all think, right, if let's say the government is so concerned about interest rate rising, they just don't increase the interest rate, then everyone will be happy. But in Singapore, because we are a small economy, we do not work on this thing called monetary policies. We depend on what? We depend on exchange rate to manage our inflations. Right? So before you take out your pillow, you just remember when you go shopping, right? Do you find that you are now getting cheaper and cheaper? It seems like go US cheaper, Europe also cheap, Japan also cheap, Malaysia also cheap, because our exchange rate is strong. And we use currencies, strong currencies, to control inflation. So then who decide the interest rate? Generally, our interest rate will depend on the global situation. And in particularly will be US, Federal Reserve. Federal Reserve is the central bank of US. In fact, a lot of the policies that they make, right, affect all the countries in the world. And then countries like Hong Kong, Singapore, we follow very closely to their interest rate. So if you look at this table, there's two tables there. Sorry. Okay, sorry, before I come to this table, you look from this chart, what it actually shows is that there is a 94% correlation. Meaning to say every time US increase or lower the interest rate, we will follow. The only time that was not extraordinary was the Asian financial crisis. Other than that, we almost follow closely to US. So if you want to know Singapore interest rate trend, what you need to know is to observe what happened in US, the US policies. So let's look at this table. The first table here will show you a 20 years period. You can see that STProperty stands for Singapore Interbank Offer Rates, 3 months. On the average, 20 years is 2%. Federal Reserve is 3.18%. But you know in Singapore, besides riding on the STProperty, we have to base on the premium that's added on to the STProperty. So if let's say STProperty is 2%, you add a premium, let's say 1%, the interest rate will be 3%. So this is how Singapore banking interest rate generally are being based on. But if you look at another, let's say based on 5 years, you look at STProperty, it's about 0.49% and Federal Reserve is 0.14%. Because US currently is at a near zero Federal Reserve rate. Okay, near zero, basically not more than 0.25%. But I want to show you another table. If you take away the last 6 years, why the last 6 years? Because last 6 years is the most unconventional. Right? We call it unconventional monetary policies. Because of what? Because of Lehman Brothers crisis. In 2008, that was at the full-blown. And the problem here is that it caused many people to go bankrupt, especially the banks. For those of you who still remember Lehman Brothers, where it's known to be 100 over years banks, cannot collapse one, but they still collapse. So that's why over the last few years, Federal Reserve has been making the interest rate near zero. And if you take away that part, you can see that our Federal Reserve rate on the average 20 years, 4.36%. And Singapore interbank offer rate will be 2.9%. So you plus another premium, let's say 1%, 1.5%, average Singapore housing loan interest rate will be 4%. And if you can recall, Asian financial crisis, Singapore interest rate shoot up to 9%. So the question here is, will this happen again? Okay, so since we all now understand that Singapore interest rate is mirroring on US, then what we want to know is, what is US going to do? Beside the interest rate, there's this thing called QE, right? It's not Queen Elizabeth, but it actually stands for qualitative easing policies in US. So where they print how much money? In total, they have QE1, okay, that's when they first started in 2008. Then after that, QE2, because they say not enough, so they need to print more money. Then QE3, and they only just stopped it a few months ago. So all you know how much they print money? $3.5 trillion. Actually, this kind of amount, this kind of number, no meaning to us really, because it's 天文 already, 天文数字, astronomical. But just to give you some perspective, based on a world population of 7 billion, basically half of the world can have an iPhone 6. Oh, by the way, I was told you have a lucky draw. iPhone 6. Okay, unfortunately, yours is only one. But if US print money, they give it to us. Half, everyone here will have it. Then if you use Porsche to measure, every Singaporean will drive a Porsche. 911. So that is how much $3.5 trillion is about. Okay. But since US say I stopped the QE, does it mean to say that there's no more free money? There's no more easy money? This is based on the meeting minutes raised by the Federal Reserve. Before the QE3 was so-called stopped, they actually say they want to measure against the unemployment rate. So if let's say unemployment rate hit 6.5%, that means lower down to 6.5%, they will start to review to increase rates. But when unemployment rate hits 6.5%, they do nothing. Currently it's 5.9%. Why? Because they are very worried about what is going on in the world. Right? You have the Europe issue, you have the China issues, you have the Japan. Basically, they are very concerned about the growth in the world. So if let's say they increase the interest rates, not only they will hurt their people suffering from the subprime mortgage, they are also concerned about the demands, right? About the US dollars. So US dollars is another big issue. So therefore, in conclusion, Federal Reserve say they will not increase rate until it deems right. So what is the question about right? What is right? Why? Because after US stop already, who take over? Japan. Japan come out and say, I'm going to print another 700 billion. Then Europe say, oh, I cannot take it. I also come out and say, I'm going to print some more. Not only they print some more, they actually mention about 500 billion to 1 trillion. On top of that, they have now set their interest rate at negative. Yes, that means you put money in Europe Central Bank, not they pay you interest, you pay them money. And it's happening now to some of the Europe banks. So much so that Germany are making a lot of noise because Germany has a very high saving rate. So now if let's say the banks are charging that, I mean of course there are terms and conditions. I mean not everyone will be charged on that, but they're talking about if those deposit rates of more than 10 million euro dollars, then you'll be imposed on such rates. But can you think about it? With Japan taking over from US, and then Europe saying that I now have minus, and plus China recently, surprisingly, also reduced their rates, what will happen? Which means to say, in short, this year or 2015, interest rate rise again may be a question mark. Okay, but not to give you the impressions that interest rate will not rise. As you can see from the table over there, over the last 20 years, on the average, what should be a normal monetary policy be? Average interest rate for US situation is about 4%. For Singapore, it's about 3%. That is what we call a normal monetary policy because you have to factor in inflation. Japan has a period of low interest rate, but what do they get? They get deflation. Deflation meaning to say the things get cheaper and cheaper. So when people think that the thing is going to be cheaper and cheaper, do you think they will buy? They will not buy. So that is the problem. So in the world, a normal world, they want a healthy inflationary environment. That's why when we invest in property, inflation is one of the very key factors that is actually our friend. A normal, healthy one. And US is also very concerned. Now US dollars is strong. So much stronger than the three currencies. If they increase the rate too high, too fast, what will happen? People will shift their money to US. They will make US dollar even stronger. And US will have difficulty exporting. Okay? I mean, for those of you who are allergic to economics, I mean, you have done well. So far, I haven't seen anyone take out pillow yet. Okay, of course, MES is very concerned about this interest rate. So let us look at now what is the impact of the rise in interest rate on housing loan, so that you can see what you need to do. So let's take as illustrations, someone age 40, 8,000. Anyway, Singapore household medium income is about 7,700. Loan amount 800,000, loan tenure 25 years. Okay, I know this is very bit small, but what we are just looking at is the existing loan package of about 1.32%, and then the other one is a rising 3 months where it will hit about 3.4% in 6 years' times. All right, 6 years' time. So total liability, right, for 800,000 is about 139,000. The other one is 342,000. So you can see just by interest rate going up to about 3.4%, the total liability will have increased by 21%. Right? So that is why it's a big impact. Let's show you another numbers. So assuming, right, this is existing one, this is a rising interest rate. So now, okay, sorry. So 1.32%, there's no impact. But what if 1.32 increase to 1.9%? You are seeing a 6% rise in your installment. Then if let's say the interest rate rise from 1.32 to 2.4%, you are seeing an 11% rise in your interest. And if 1.32 to 2.9%, you are seeing a 15% rise. And if you hit 3.4%, you're looking at a 19% rise in your installment. So the question here is, can you take it? Will you be able to shoulder it? All in all, you're talking about a 3,001 installment to 3,008. Now, based on this situation, this person generally is still quite okay, provided he has no other outstanding loan. That means no car, no credit card, whatever, because 8,000 ma. So 3,008 is still less than 50%. In that sense, he's still able to shoulder. But if you look at our median household income, our annualized increase in household income for the past 6 years on the average is only about 4%. So a 4% pay increment plus, with reference to a 19% increment, can you see a lot of people will not be able to shoulder that kind of impact. That's why MES have no choice but to come in, to step in. They have to intervene. So how do they intervene this? How do they manage this? And how should you, as an individual, look at this? Of course, they have introduced this TDSR, Total Debt Servicing Ratio framework, where they introduce your your ratio not exceeding 60%, income weighted average ratio, that means to say based on the income of the joint borrowers, and setting at 3.5 and 4.5%, right? When we introduce this, STProperty have organized and we have actually shared and illustrate and analyze the impact about all these things. So I'm just doing a very quick review. And if you look at the interest rate that MES have actually set aside, 3.5%, it's actually quite close to the table I showed you earlier on. If you remember, and we are looking at a 20 years average. So 3.5%, in my view, is quite safe. And we should be very, very glad that we have a regulator that is really on the ball. Okay, they are on the job. Because as much as people are complaining, hey, remove the cooling measures, stuff like that. But can you imagine if the central banks don't do anything, which is what happened in US and Europe, which resulted in the Lehman Brothers crisis, do you want a bubble or do you want a healthy market? Okay, by the way, I'm politically neutral also. So then they also introduced MSR 30% for HDB and EC. So basically they are trying to promote prudent financings, prudent loan mortgagings. So what you can do as an individual, first review your own mortgages. If you have, right, if you have mortgages, what you should do, go and refinance, reprice. Because you can look at here, this is based on the 800,000 loans. By refinancing from a 4.5% to 1.3%, he basically saved 66,000 in interest costs. So this is a lot of money to save over a period of 3 years. But now, some of the banks are actually taking advantage of TDSR to say when you refinance, I want to show you all the documents. But anyway, under MAS Notice 645, which is the notice govern the TDSR framework, right? They actually provided exemptions if it's a property owner occupied. But even if you're investors, they give you certain grace period until 2016. So you can always take these opportunities and reassess, try to switch out to interest rate that is lower. So then the next question is, okay, so what package should I go? Now, at Sing Capital, we help customers to compare. We show them what are the different mortgages available in the market at the current moment. Okay, so don't look at the bank sales, it's just to show you we really measure and compare line by line what are the terms and conditions about different mortgages. So which one is most suitable? In the market, generally it's based on the STIBOR or based on the fixed rate. If you ask me, my first choice, go for fixed rate. But if you have, if you agree, right, with my assessment earlier on, interest rate will have to rise, but it will be in a moderate level because US, based on their meeting minutes among the Federal Reserve or the governors, they actually have a general consensus by June 2015, they would likely increase the rate by about 0.5%. But this increment will be moderated because of Europe, Japan, China, and they also have to factor in their currencies. So what you can do, really look at your own needs, whether do you be selling your properties, will you be doing certain things about it, so that you can actually do a management and we can advise you better. Is fixed rate better or STIBOR rate better? Okay, then the next thing is, since interest rate is going to rise, will it mean to say property market will crash? Do you think that a high interest rate will cause a property market to crash? Let us look at some numbers. Okay. Now I show you two tables. The first table is URA price index. The lower table is talking about the bank interest rate offered by a finance company over a 15 years loan period. So we go all the way back in 1993. Okay, I know it's very small, but basically, if you follow here, finance company mortgage interest rate is about 6.5% back in 1993. 6.5%. So Singapore interest rate was never that low. But how come when interest rate was high, the property price index go up? Why the property price still move up? Because there's a lot of factors. If you remember, that was just after the Gulf War. Oil price was low, and then the whole world, especially in Asia, the ASEAN, Si Xiao Long, all these things, they were all doing very well. And our GDP was as high as 15% annually. So even though interest rate was high, but it was a reflection of a bustling economic activities. So property price actually went up. However, when there is a crisis and the interest rate shoots up, what happens is that you can see there's a sharp decline. There's a sharp decline. This was in 96, 97. So therefore, a high interest rate doesn't mean to say it will cause the market to crash, because you have to look at it is what are the surrounding factors. And the next one I would like to show you, okay, because of time concern, actually this chart, there's a lot of things you can read about it. And that is what we do. Our research departments, we analyze, because there's no point for us to say, oh, you should do this, you should do that. But what is the basis? What's the reference? So I just want to highlight this portion to you. The next time, if you see another trend where the bank interest rate was trending very low, right? And then the URA price index was also very low, okay, pawn whatever you have. Put all your money in property. The reason is that the market shoots up. The market shoots up. So, I mean, I was sharing just now with the fellow speakers, Malaysia, there was another interesting trend. I was also researching on the impact of GST from Singapore experience. And when we introduced GST at 4% and 5% in 2003 and 2004, it happened to be in this period of time. So at that period of time, GST did not cause the property price to go up. However, there was a built-up pressure. So when 2007, they introduced 7%, the property price also moved up. So if you go back all the way to 1994, that was another interesting finding. Yeah, of course, today is not the segment about this. So over here, what we are trying to say, doesn't mean to say interest rate high, property will crash. But if it's coupled with a crisis and a high interest rate, property will sure crash. Because I do not want some of them to think that, oh, since interest rate is going to be high, I better don't buy, or I better sell my properties. Not because of that purpose. Then let's look at GDP. The other thing is about GDP. Fundamentally, a property market can go up or not. It all depends on the GDP growth. So over here, again, the top part is the property price index. The property price index. So below is the GDP. As you can see from here, it's quite closely related to the performance of GDP and the property price. And you look at here, from 2003, that was the SARS period, right? Until about 2007, GDP was actually moving up, although it was quite volatile, up and down, up and down. But you look at our property price, it was slipping, right? Because we just came from a very high bubble. So the whole property market was really slipping, plus low interest rate, plus GST. That was why in 2007, the property price just boom, just shoot up all the way up. Okay, so the next question here is, of course, what will be our property price? So it all depends on our GDP. What do you think our GDP is? But now there's another factor. There's a political factors. There's a very, very strong factor there. And you have seen from the neighboring country. Right? A high property price with a high cost of living can result in protests. Anyone been to Hong Kong recently? I know of some friends they purposely fly there just to see what is happening. But actually, for Singaporeans, these are very rare sight. So sometimes maybe it's worth to make a trip there. Can you imagine this happen in Singapore? Some little thing in Hong Lim Park already got such a big reaction already. But it's true, because property price when it's too high, that is not concurrent to the income growth, will result in a lot of dissatisfaction. And election year is coming, so that's why now a lot of people are saying, hey, when will the cooling measures be removed? Actually, the MAS look beyond more than that. It's not just about property developers or whatever. Okay, by the way, a lot of the property developers are saying that, wow, this is hurting their business, right? If you have read the Financial Stability Review that just published by MAS, it's a very, very insightful report. For those of you who are interested in this, you should go to MAS website, you can download it. It's very extensive. It shows that our central bank really examine all the things that's around the world. They first look at the whole world global economy, then they examine the household debts. So there's a few interesting numbers that they found. I'm going to show you in a short while. But one of the things that they commented in the report is that generally, on the average, property developer in Singapore has a current ratio of 2.5. Meaning to say, they have $2.5 of assets against a $1 liability. Bottom line means what? They got money lah. They can afford to lose. Don't make so much so that people like us got chance to buy property at a lower price. Okay, because the other thing that MAS also look at, right, the central bank also look at, is our total liabilities. Now the good news here is that generally we are not so highly leveraged. Right, earlier on Mr. Tang shows Malaysia is quite highly leveraged. Singapore is actually quite good. And that is one thing I must say. You know, the Americans they are brilliant people. No? Lehman Brothers crisis was created by them. But who kena? Basically the whole world suffer. No? Not only the whole world suffer, now our whole processes in boarding up clients also go through a lot of changes. No? And then because why? Although they are one of the highest debtor country in the world, but basically they borrow money from the world. So when they are in trouble, we die. No? But they are not the biggest debtor. No? Who is the biggest debtor? Japan. Japan is the biggest debtor country in the world. Much, much more than US. But the problem with Japan is that they borrow internally. So if they cannot pay, then their people die. So there is the situations that a lot of governments in the world try not to let it happen. They try to prevent. So if you look at here, if we factor in all these statistics are from SingStats, we factor in shares, CPF, property, insurance, currency, total liabilities. The orange line will be the total liabilities, which is about 16% of our total assets. So in that sense, we are healthy. Then how about liquidity? If we factor in cash and CPF, our mortgages is about 35%. Okay? Again, a healthy sign. However, the central bank are concerned. You know why? Of all the debts that Singaporeans have, more than 3/4 is mortgages, properties. So as we have shown you earlier on, if interest rate go from 1.32% to 3.4%, what is the changes, the impact? 19%. So the mortgages, that is 3/4 of every Singaporean's household debt, could balloon it very much. And so this is what they want to actually manage it. It's a very, very important thing. But what we are trying to show you here, right, interest rate generally is going to moderate, it's going to go up, but it's going to be moderate, and overall Singapore market is still in a healthy zone. So the bottom line, what can you take away from here? If you are investors, my friend, I really urge you to do a proper financial plan. Because why? We have seen read from the newspaper, but my friend, I tell you, I've come across it ourselves because we are financial advisory companies. So we advise customers or wide range of financial services. One of them is mortgage. And mortgage is not only helping them to get a mortgage. One of them is helping them to get out of situations. So if for those investors who are highly leveraged, highly geared, you need to do a review. And if you need to, you better sell your property. Because the interest rate is going to stay high. Sorry, it's going to rise and it's going to stay in a high rising level. Now, just now the example with the case study is based on 800,000 property, right? The installment was how much? 3,008. But can you tell me, what is the likely rental of an $800,000 property in Singapore? My guess is $2,000 to $3,000, which means to say you cannot afford. No? So therefore, mortgage sale is looming for those who are highly geared, highly leveraged. But for those of you who are buying for own use, or you are looking for this opportunity to upgrade, my friend, take advantage of this, because MAS have really helped you to run through TDSR. They really factor for you 3.5%. If at 3.5% as a credit assessment, you still can qualify for the loan, you have no worries. Then, while interest rate is still low, take full advantage of it. Make merry of the low interest rate to your advantage so that your properties, you can have a very, very good investment over the long run. So in summary, interest rate is going to rise, but it may not rise as what a lot of people fear too, because of the reason I've shared with you. US is concerned about the global slow growth. Europe, Japan are low interest rate. In fact, there's another angle to it. Where should you put your money based on all these factors? Okay, but of course, again, today not a session. So you can go to our Facebook to like, so that we can keep you updated, notified of whatever things we have. And we are now closely monitoring what is going on in the world, so that we can share with our fans what is the situation. So we publish a lot of articles on the Facebook, so go there and to like us. Or if you have any other inquiries, you can send this email to us. Oh, by the way, I have this book outside today, special. Normally bookshop is $30, today $25. And like what ST Property always do, they set very high standard. So any other value I can give you, if you don't mind, I can give you a free autograph. But optional. Sometimes people say don't dirty the book. But this book is really about holistic financial management and how you can grow rich as a Singaporean, leveraging on the properties, CPF, and have one chapter on all the summary of all the cooling measures in Singapore. So with that, really, I wish you all the best to your investment, and thank you very much.